This episode is brought to you by Paraswap, the leading aggregator to find best prices across various DEXs. You'll hear more about them later in the show.
I always say to people, you want to be an innovator in financial markets, one of the most regulated markets in the world, show the regulator that you can do their job at least as well or provide at least as much, and then have at it.
All right, everyone. Welcome to another episode of Empire. We have Santiago co-hosting this one, and we are very lucky today. We are joined by the best dressed guest, that's a mouthful, we have ever had on Empire. We have the former chairman of the SEC, Mr. Jay Clayton. Jay, welcome to the show.
Thank you. It's nice to be with you both.
Awesome. Santiago, you and me are feeling like real scrubs right now without our suit and tie.
I know. I don't usually wear a tie or suit, but I still have them in my closet. But I can't remember. I mean, I think I still remember my first Bitcoin meetup in 2012, and I was at JP Morgan. I go down to the Soho Center, the Bitcoin Soho Center, and they all look at me and said, "You definitely have the wrong room." So, but anyways, more than welcome here, Jay. I think you bring the industry is becoming more professional. So I think you're the embodiment of the new people that are coming into the industry, which is great to see.
I don't know. I like to say I have a binary wardrobe. It's either this or flip-flops and a bathing suit. So that's what you get.
Hopefully more days in the flip-flops than before these days. So, but Jay, I want to we're gonna talk all things crypto. Obviously, really excited to get your takes on some things. You had this amazing op-ed in the Wall Street Journal a couple of months ago titled "America's Future Depends on Blockchain." We'll talk about that. But before getting into crypto and digital assets and blockchain, I actually wanted to go back and revisit. There's this one story. You spent 25 years at Sullivan and Cromwell on the private side. There's one story I just had to ask you about, which is the financial crisis, right? 2007, 2008. You advised Bear Stearns on kind of their fire sale to JP Morgan, Barclays and their purchase of Lehman Brothers, Goldman, and their whole deal with Berkshire. Were there any lessons that you learned during the financial crisis and advising on these like very, what I would call maybe high-powered deals? Any lessons that you learned during that time that have really stuck with you?
Sure. There always are in times of stress. You know, you learn a lot in a short amount of time. But one thing that I think we all learned that then was beneficial was how important it was to quickly stabilize short-term funding markets, and that came to the fore in March of 2020. So March of 2020, we shut down the economy. Now, at that time, no one really knew just how widespread the effects of doing that would be. But as is almost always the case, some large macroeconomic move immediately manifests itself in the funding markets. And you saw a flight to quality, which could in itself be destabilizing. There were a number of us who had been around during the 2007, 2008 period, who had the view that had government acted faster in 2007, 2008, things would not have been as bad. And what we did was we took the tools that were eventually used in 2008, 2009, and said, let's apply them promptly and see if we can stabilize these things. And it actually, I take my hat off to Stephen Mnuchin, Jay Powell, the folks on the Hill who worked with us. The market stabilized amazingly quickly. Corporates were able to term out their debt, and you saw that the economy adjusted from a service economy to a goods economy without a lot of friction. We're now living with some of that. Maybe we spent too much money. Maybe we didn't do things perfectly. But that was a lesson learned that at the time, let's just say March to June, was very beneficial. There was muscle memory.
Yeah. So you would call what happened in March of 2020 a big success in terms of stabilizing the economy and just getting everyone on their feet. And it really took only like 90 days, which was, as you put it, very quick.
So yeah, I mean, I'll put it into two categories. There was the monetary policy side, stabilize the funding markets, because every market ties back to the funding markets. It's just the way it is. And then on the fiscal side, keep the consumer at some level of confidence. So that's what the CARES Act did. So those two things together, limited the amount of disequilibrium in the US economy. And I would even posit that greatly helped the world economy.
Yeah. We had Do Kwon on the podcast the other day. I don't know if you know Do Kwon or if you've heard of the Terra ecosystem in crypto, but one of the fascinating things about Terra is they've built this entire open market without a centralized entity. And obviously other folks in crypto have done this as well. And this is really what has come to be known as DeFi, right? You're building a lot of these financial applications without a centralized entity. But even bigger, a lot of these ecosystems are now building these open market operations without the centralized entity like a central banker. Obviously, sometimes things don't go as well, and maybe there's a hack and someone has to step in or whatever it may be. But it sounds like one of your takeaways from 2007, 2008 is how, and from March of 2020, is how quickly we were able to kind of stabilize the markets in these by acting in these open markets. What is when you see this happening in crypto without a centralized entity, does this excite you? Does this scare you? What are your like gut feelings when you're seeing all of this play out?
Well, what do we use centralized entities for? We just talked about one, which is sort of macro policy matters, whether it's monetary or fiscal policy. The folks who think that you could have a world of decentralized finance, I think ignore or choose not to accept just how already integrated, how important, and how powerful having a central bank-based system is in terms of stability, confidence, all of those types of things. We could all argue about whether they use that power correctly or not, et cetera, but it's pretty fun. And then what I would say is on the product specific side, how much, what I would say is confidence and resilience you need to have, confidence in and how much resilience there needs to be in a DeFi system for one key area, which is responsibility. When something goes wrong, when the rules of the game are not followed, think of a theft. I think there was something overnight along those lines. Who is the responsible entity? Or is it caveat emptor for everybody participating that there'll be some unanticipated event? You could have something that works on that basis, but it would be hard to see something working across the consumer financial system where you had that type of risk borne by all participants.
I think if I'm putting my crypto builder hat on here, I would counter that and say, well, what we've seen in crypto is when you have a big hack, like there was this thing called Wormhole that got hacked, instead of someone like the Fed jumping in and having to backstop it, and this government participant jumping in and maybe printing money to backstop it, or whatever it actually looks like on the back end. In crypto, it's because it's completely open markets. The person who jumped in to back it was Jump Capital because they have such a and they're incentivized to stop it. And we had a hack yesterday. It was like this Ronin thing, and massive hack. And whoever comes in to backstop that, it might be Axie, it might be Delphi, it might be Andreessen Horowitz, whoever it is. Though they're going to be heavily incentivized to backstop it in kind of these free markets instead of what maybe it looks like in traditional capital markets, where someone like the government, who's not actually as much of a player in the like capitalistic free markets, jumps in.
I think you have a good point, and I think it's applicable in certain markets. I don't know that perspective will carry the day in our traditional retail finance markets, in our consumer lending type markets. The reason is also a political one. We long ago departed from caveat emptor for what I would say is essential retail credit matters. I mean, look at how much documentation and regulation there is around mortgages, right? We're not going to shift to a decentralized caveat emptor mortgage market. We can think about it, we can postulate, but I doubt that will happen.
I like to think about, one of the things in my conversation with regulators is, there is this sort of gap where some folks within crypto say, let's just blow up the existing financial system. As we know, we can't trust centralized institutions. It's sort of very utopian, not very practical. I think that sentiment is become sort of a minority thinking amongst crypto participants. The industry's grown up. it's less hobbyists, it's more professional folks coming into the fold that understand the benefits of this technology, like the internet, that just is streamlining a lot of operations. So it's not to say that Wall Street or certain institutions are gonna go away. There is still probably some degree of centralization, but at least you can streamline, bring more accountability, more transparency to certain systems, like the financial system that back to 2008. Likely the extent by which the markets kind of didn't understand what was going on and what institutions and the amount of exposure that they had probably wouldn't have happened if you had a decentralized system where you could on-chain verify a lot of these things, right? If you had the Abacus instrument that Goldman was, selling, well, if that was on-chain, you could have understood the exposure and who the participants were. Privacy is a concern. So this is where I think DeFi fits in as a new payments rail, a new financial rail that is adopted by banks. Because, as you point out, there's a lot of operational, fluff and compliance stuff that could probably go away if you have a public, transparent blockchain. I'm curious to get your take on how do you see these two worlds coexisting, both from a regulatory perspective, but also from an industry perspective, from your vantage point.
Yeah, and Santiago, you actually just captured using the mortgage market as a basis exactly how I feel about where crypto technology is going to make a transformational difference. And if you look at that market, I said, look, we're never going to turn that over to a caveat emptor market. The government is going to monitor it. The government is going to regulate it. But the amount of friction, both on time and on process in that market, and even though you have all of those frictions over time and over process, the lack of transparency and real-time data in that market is pretty remarkable. And you can see, blockchain, crypto technology, whatever we want to call it, tokenization, and it's what I like to refer to it, transforming that market to an amazing extent and actually achieving the regulatory goals to a greater extent. So, I always say to people, you want to be an innovator in financial markets, one of the most regulated markets in the world, show the regulator that you can do their job at least as well or provide at least as much, and then have at it. That is, and I think the mortgage market, whether it's residential, commercial, is ripe for exactly that kind of transformation.
Mm-hmm. How, from your perspective over the years, do you think that narrative and sentiment, like where are we in that sentiment being the majority on the Hill amongst these government agencies?
Yeah, look at how much has changed in the last 12 months. You mentioned the op-ed that I wrote in the journal about bringing blockchain technology to our core funding markets and how much efficiency that would add. 12 months ago, most central banks, crypto was what I would say was a scary and somewhat, people may say dirty word. Now, most central banks, and you see this in Europe and you certainly see it in Asia, are embracing the idea that crypto is going to be part of the core plumbing in the global funding markets. It's almost a 180-degree switch in less than a year. If they have that perspective, they're going to be much more receptive to crypto coming to the product markets.
Mm-hmm. I want to ask you, a lot of times crypto folks can commit the fault of being defensive and over-promising and very idealistic, especially when we're talking to regulators, and even hostile. What are some of the things that you've seen that we can do better as an industry to strike dialogue with regulators and people that might be a little bit skeptical? For everyone out there listening, because I think there's a lot of growing interest to speak with the regulators. Sometimes it can be daunting, but invariably, I think sometimes we go and talk to them like you're talking to like your parents, and you've committed a fault almost.
Yeah, I think and it's an understandable error, if you want to call it an error or perspective, which is people in the community um, understand the efficiency power of this technology to such an extent that they're like, hey, regulator, we're going to save consumers 50 or 100 basis points across these products. Think about those benefits and kind of blow by some of the things that are really important to regulators. And it ranges from the prudential, which is, is there too much credit, to the national security, AML, KYC, to a focus of my old agency, which is investor and consumer protection. There is no amount of efficiency that is going to let a regulator put that responsibility to the side. So that's why I say you, at least whenever you're in front of a regulator, whether it's a prudential regulator, national security regulator, consumer investor oriented regulator, you have to respect the fact that that's their first job, maintaining that level of protection. And then if you can do that and achieve efficiencies, have at it. The crypto community said, look, there's a trade-off here. Let's make it. Let's take on a little bit of AML risk. Let's take on a little bit of KYC risk because we're adding so much efficiency to the system. It's one perspective, but it's not a perspective that's going to win the day.
Would you say that the main priority and concern and perhaps perspective that we should be playing up is consumer protection?
I think you have to be. So if you're talking to, let's just be clear, if you're talking to the Fed or the banking regulators, that's consumer protection is important, but the most important thing is stability, financial stability. If you're talking to the Treasury, or you're talking to some other folks, the most important thing is AML, KYC, Bank Secrecy Act. If you're talking to the SEC, CFTC, CFPB, it's the retail participant in the marketplace, and are they protected? So it depends on who you're talking to across our patchwork of regulation. But I do believe it's not that hard to bring the incredible efficiencies of crypto technology into and accommodate all of those perspectives. Stablecoin, you can see the mindset switch on stablecoin. People know how scalable it is because it has scaled. There's no need for a sandbox. We have a real live experiment going on where stablecoin is the link between crypto assets and the incumbent financial system. Mm-hmm. It's highly scaled, highly efficient, working really well. And what you see in the president's executive order is, let's bring that into that prudential regulatory system so that we're confident that it's not over-levered, that consumers are protected, and that you can have some kind of permissioning system so it's not being used for terrorist finance and the like. I believe the president's executive order recognizes that that's possible and is probably coming.
I do want to talk about the executive order with you, but one thing so you're talking about these different agencies, right? And each one is kind of concerned with a different thing. Maybe the SEC is concerned with like consumer protection. Someone else is concerned with stabilization of the system. Everyone's got their kind of their end all be all, their one sentence that they really care about. It strikes me that no one is concerned about maybe leveling the playing field or like income inequality in the system right now. And one thing, I think it's great that the SEC focuses on consumer protection. And you talk about this caveat emptor and like buyer beware, right? But how do you draw the line? How do you think about what's the right level of that? Because if you take maybe like the accredited investor might be a good thing to double click on. That's obviously gotten a lot of flack in the past couple of years because it's kind of pushed kind of the smaller people, maybe the retail folks, out of this massive upside on the venture side of the markets. Yeah. So how do you protect, and then they're left just maybe participating in the IPO and the public markets once a lot of the juice has already been squeezed out of the lemon. So how do you think about that?
So that is something that has very much bothered me. What at the end of the day, when I think about any regulatory move, I think, okay, middle class investor, from a what does this mean for them in term and let me give you some stats that'll be amazing to you. I think will be interesting. and then I'll come back to your specific question if you don't mind. During my tenure at the commission, fines, penalties, disgorgement, other types of remedies ran about $4 to $5 billion a year, in very much the name of protection of the markets and protection of retail investors. And we returned a larger portion of that to actual investors than had been done in the past. I feel great about it. People are like, what were you soft on? Were you soft on crime? Were you soft on transgressions? Actually, no. We had the highest amount returned, highest amount collected, and nobody really complained that they were overly burdened. $5 billion. Let's just say there's 10 trillion in retail assets invested in our markets. If I have my math right, and you save those people 50 basis points on average across the marketplace, that's $50 billion a year, 10 times what you get from a vigorous enforcement program in terms of returns to investors. Not saying you shouldn't have the vigorous enforcement program, but think of the power of that kind of efficiency. That's what we need to be thinking about bringing to middle class consumers, investors every single day. And we've done a good job of that in the public equity markets. They sit side by side, pay about the same costs. Over time, costs for trading, costs for access to products have come down. To your very good point, the cost of access for the middle class American to the private markets is prohibitive. And the cost of accessing a middle class American from the entrepreneur's point of view is prohibitive. In a world where we have the technology that we do, including what crypto does, that's ridiculous. It's absolutely ridiculous. And we have to find a way. I had some proposals to allow middle class investors access to the private markets. Look at a 401k plan, which is almost all public equities, debt, and cash, compared to a well-managed pension fund, which has all of those, but also has some meaningful sliver. Maybe it's 5%, maybe it's as much as 15, 20% in alternatives. Why we can't offer that to a retail investor is absolutely beyond me. And in fact, we can. We just have to figure out how to do it. And I'll just say a political thing here. There are people in various who do not like the non-public markets. And they do not like the non-public markets because they're not as uber transparent as the public markets. But let's recognize that the public markets are built, and what we've added to the public market regulation, built for enormous companies. They're no longer built for mid-sized and small companies. So we have to have an alternative if we're going to have a thriving economy. Don't ruin that alternative. That alternative has done so much in terms of innovation and just find a way to give retail people fair access to it.
Yeah. I feel like, Jay, I got to say, I think you just walked into my next question, which is we just created a system over the last decade where instead of having private markets for the first 10 years, you raise a bunch of venture money and then you raise growth stage and then you IPO and then now you've got retail getting access to the public markets. We've built an industry with crypto where now you have public markets almost from day one, which obviously has a lot of downside. Imagine if Uber was public the day that they launched. That stock would have been trading up and down 99% every single year, right? So there's obviously a massive amount of volatility and downside with that. But the upside is it gives users and retail access to these private markets earlier on. So what is the worry and why is it so hard to do things like access tokens and invest in tokens? And what is the concern there if there's so much love for public markets and hatred of the private markets? Well, we just created a way to have public markets go earlier.
Well, it comes down to a fundamental point in our security system, which is information asymmetry. What we decided, and it has served us incredibly well, is that if you're going to go broadly out to the public, you have to put the broad public, both in the initial distribution and in trading, on a level playing field with the company insiders. And we're not going to get rid of that. Okay, we're not gonna have a system where you can go out and raise hundreds of millions of dollars for a project from anonymous people who trade amongst themselves and buy with the expectation of liquidity without having that level information playing field. That's not going to change. Okay, and it shouldn't. It has worked really well. You can argue that we've made the cost of participating in that higher than it should be. I mean, if you look back at prospectuses and annual reports when I first started, they were under 100 pages for the initial public offering prospectus, and quarterly reports were 20, 30 pages. The annual report might be another 100 pages. What we have today is a very cumbersome system built for large companies. Like I said, we could try to pull that back a bit. But let's go to the private markets. What's the notion in the private markets? Is that if you have a sophisticated investor between the venture, and whoever is the ultimate beneficial owner. So when a pension plan invests in a venture, it's for the benefit of the participants in the pension plan. You have a sophisticated investor. We can figure out how to do that, I think, fairly easily. So
yeah. All right, everyone, quick break from the show to share a big update from our friends at Paraswap, the best platform to stake, swap, trade, farm, and more. Paraswap just launched gas refunds. Based on how much you stake, you can now get up to 100% of your gas refunded on all of your swaps on Paraswap. This is huge. For anyone who has spent a lot of time in DeFi, or maybe is just starting out, you know how egregiously expensive the gas transactions can get. The gas fees are ridiculous at some points in time, and now you can get those entirely refunded on Paraswap. To participate, all you need to do is stake a minimum of 500 PSP. Big shout out to the Paraswap DAO for making these refunds possible. Really, it's tough to beat Paraswap right now. They give you the best prices. They save you money. You've got this gas refund if you stake PSP. They've got a smooth and really user-friendly interface, fast swapping. It's really everything that you'd want from a DeFi platform. If you don't use them already, check out Paraswap today at paraswap.io. Now, let's get back to the show.
I want to turn to a topic that has been kind of front and center around this. You talk about asymmetries of information and protecting market participants against market manipulation and all these sort of things. One of the things that has been tried over the years is an ETF, particularly a Bitcoin ETF. It keeps getting rejected around. You might be more privy to this than I have, but my understanding is they keep making the argument that the market's kind of not very robust and it's subject to manipulation and all kinds of things. Seems to be a lot of interest and appetite from folks that want to get exposure to this asset class. And so I am curious what your thoughts are on an ETF and why the hesitation, especially where we are now. It seems like the industry is pretty robust now.
Look, I think when the trading markets for, we'll just use Bitcoin, were in their incipient stages, themselves decentralized, multiple venues around the globe, some with lots of liquidity, some with little liquidity, etc. The idea that underlies an ETF like that you can be confident that the pricing for the ETF is not manipulable. That was a very legitimate concern of mine, of the regulators. I mean, think about it. You had all of these different. Name another product that would trade on a dozen venues, some with very little surveillance. There wasn't one. But what I would say is, as the trading in that market has matured, and like anything, become more centralized, those arguments those considerations become much less acute. So I think we are trending toward what I'll say is spot markets that are more reliable and therefore can be the basis for a product.
Can we ask you for a prediction here, Jay? If you had to put a timeline on it?
What I will say, and in fairness, this is not new. Regulatory timeframes are always difficult to predict because they're a function of the issues of the day, right? There was a lot that I wanted to get done in 2020 that I just didn't have an opportunity to do because I had to deal with markets that were destabilized and making sure that whatever pandemic responses we had operationally and from a market perspective had to be taken care of. So, it is always difficult to predict timelines. But I do say I'd be interested in your guys' view. Don't you think that what I would say is spot Bitcoin trading is much more reliable from the perspective of manipulation concerns, leverage concerns, and the like that it was 3 years ago?
Absolutely. But in the same way that you could compare it to the gold markets, I think, right? And I think there are just some big investors or maybe my 70-year-old father who just wants like a Bitcoin ETF to buy and doesn't want to go custody his own Bitcoin in the same way that he doesn't want to buy gold, he wants to buy GLD. So, Jay, when you look at, I just want to be conscious of time. I know we only have a couple minutes left here. When you look at things like the BlockFi $100 million fine, again, I'm not sure if this is still open or if this is a closed case. So I don't know if you can talk about it. My gut reaction when I see that, I love BlockFi. I've been a fan of them since day one. They get this $100 million lawsuit. Then you have some like shady crypto companies and like the long tail of some of these weird DeFi things that there's no attention on them. Why is someone like BlockFi, who wants to work with the regulators, or the Coinbase Lend product that wasn't able to get to market, why are these the focus when they're trying to work with the regulators instead of some of these like shadier long tail of crypto?
Now, I think that what you saw in the BlockFi settlement was a company that says, okay, let's try and find a path forward where I can check the regulatory box, which has value. That's just one item there. In terms of looking across the globe, because this is a global, what I would say is crypto, et cetera, is a global phenomenon, right? It's part of its attraction is it's borderless. Part of regulation is it's limited to borders. You are going to see similar companies not subject to the same scrutiny from a enforcement point of view, and it's just a matter of jurisdiction, bandwidth, and the like. There's no inherent unfairness in that. It's who draws the attention, etc. And people who are similarly situated, and one is subject to a regulatory action in some jurisdiction, and the other isn't. The one who isn't, may be getting a pass for the moment. Doesn't mean they're going to get a pass over time. In fact, if you see someone who is a similar situated product, subject to an enforcement action, you better expect that may come for you. And what's interesting about this, from my perspective, is we're going to see consolidation. We're going to see integration in what I would say is the traditional financial system, and we'll call it the digital crypto. We're going to see that regulatory question. Do you have legacy regulatory concerns is going to be a consideration in that consolidation. People will, as always, take some regulatory risk in a new area, but they won't take what I would say is acute legacy regulatory risk.
Yeah. Do you think that Gary Gensler is doing a good job with this? Not a good job? Like if you were hit, I don't know if that's a too politically charged question there, but what are your thoughts?
Here's what I'll say about these jobs. You don't know how hard they are till you sit in the seat.
I can imagine.
And you face these different things.
Yeah.
So there are some things where I don't agree with the direction that the current SEC is going, but there are very few. I mean, there are very few. Uh, what I would like to see more of is more cooperation across those federal regulators. We started this podcast noting the interests of the Fed, the Treasury, the OCC, the FDIC, SEC. The EO is a good step in that direction, but there's a lot of products that span the jurisdiction of all those entities. I'd like to see some more cooperation across the government.
Yeah. All right. Two last questions here, and then we can let you get on with your day. Biden had this exec order on March 9th that basically laid out like 6 policy objectives: consumer protection, financial stability, use of crypto for illicit crimes. What were the other 3? Financial inclusiveness, responsible innovation, and there was one other. Oh, U.S. competitiveness. When there was Jeremy Allaire, the CEO and co-founder of Circle, tweeted out that this was this watershed moment comparable to 1996, 1997, when the government woke up to crypto. He said, this is the government waking up to crypto. And it was generally seen as this really positive executive order for the crypto industry. Did you have the same interpretation of this? And like, was there a specific theme that stood out to you in this executive order?
The theme that stood out to me was a recognition that the technology that has been proven to be scalable and resilient by what I would say is the rise of crypto is going to come to not just the incumbent financial system, but other aspects of our life. Gaming, gambling, there's a number of things where it's going to come, and it is and then a recognition that is a competitiveness issue. I mean, putting my U.S. hat on, which is really important to me. We won the internet race. What I would say is the FANG stocks are a result of the incredible human capital, investment capital that focused on that transition to, what I would say is the internet being the backbone of our consumer economy.
Yeah.
We did great. We want to do that again in this space. And I think there's a recognition in the EO that that's where we are.
Yeah, well, that's really exciting to hear. I mean, I think a lot of people sometimes get lost in the narratives and the headlines, but my appreciation has always been that regulators really, at least in the US, really want to push innovation forward. And it's been kind of interesting and exciting to see that there is that growing support, that they recognize now that this is probably perhaps as equally as important as the internet, and it's important to regulate it sensibly. And look, for what it's worth, India, China, some other countries have been much more aggressive in clamping down on crypto and then backtracking, whereas the US, for all there's always regulatory walls of worry that we've had to climb over the years in this industry for as long as I remember. But if you look at the actual data, the US has been in a very much, let's understand this, let's talk to market participants and kind of buy us some time as this industry matures a little bit, and certainly clamp down, as you say, on legacy regulatory stuff. Anytime there's fraud, anytime there's just blatant scams, and yeah, definitely clamp down on that. And I think no one in this industry would disagree with that. I think most people within crypto would say we need regulation, we need more clarity, because there's so many people that are on the sidelines. But hopefully we can get there soon.
Yeah, and let's go back to U.S. competitiveness, because this is just really important to me. The global use of the dollar as the as not just the currency of trade, but also as the kind of stable store of value in both the short and the long term is an enormous benefit to the U.S. And the way the U.S. is I'm going to sound like a flag waving person here, but I am in this. And the way the U.S. has responsibly administered the dollar globally, for trade, has been a fabulous thing. But if the technology, or what I would say is using that dollar-based investment and trade network, doesn't keep up, that's at risk.
Jay, this is such a good segue into the last thing I wanted to get your take on, which is stablecoins. This is not a black and white issue. It's a massive spectrum, I would call it. On one end of the spectrum, you have CBDCs that are not even really on a blockchain, I would call them. Then pushing further on the spectrum, you have CBDCs maybe issued on something like Ethereum. At the very other end of this, maybe in the middle, you have something like USDC, which is this like regulated stablecoin backed by fiat reserves. And then on the other end of it, you have something maybe like Terra's stablecoin, or maybe even pushing further, you have like Frax and these decentralized stablecoins. When you talk about, or there's this guy Jim Bianco who we had on the podcast maybe a month or so ago, and he was making the claim, the argument, I would say, that the government won't actually allow these privately issued stablecoins to scale because of the maybe potential systematic risk in the case of a bank run, something like USDC. And that's why some folks in crypto are so excited about these very decentralized stablecoins. What is the regulators' take on something like a USDC, and then pushing even farther on the spectrum, what is their take on something like these decentralized stablecoins?
In the time we have left, let's try to break that down. One thing about a USDC or any central bank digital currency is there's a fundamental change if you're going to adopt that, which is the central bank now has privity, direct connection with the consumer. That is something that I'm not sure if I were a central banker that I would want to take on, both from what I would say is a consumer relationship. Central banks are really large scale wholesale operations. So big shift. So that there's that. And then there's the technology. I mean, think about a government entity like a central bank being responsible for the technological backbone that supports daily consumer transactions, or some portion of those. Not a thing I love either. The government is not the best at building, maintaining tech systems. What do we have? Our commercial banking, and I don't want to be just commercial banking, because you can look at all sorts of other participants in the financial system who have built technology. That technology is pretty darn good, and it generally keeps up to date. So, I, for one, see private stablecoin as a better way to go than trying to have a ubiquitous CBDC from a traditional role of central banks, but also from a technological and resilience point of view. And you did a terrific job of laying out the spectrum of possible providers of stablecoin. I do believe that on your spectrum, it will be either within the regulated banking system, where understanding any kind of fractionalization and reserves and the like is sort of time tested, or it will be backed pretty much one-to-one with cash and short-term treasuries. I think we're going to gravitate toward one or both of those two alternatives. But having what I would say is a levered stablecoin, which really just looks like a money market mutual fund that is not regulated like a money market mutual fund, is unlikely.
Well, Jay, this has been a fantastic discussion. I know you're incredibly busy, so really appreciate the time. For anyone out there listening, I mean, there's a whole host of people that listen to the podcast, from industry to crypto native and uninitiated people. What would be, any parting thoughts to anyone listening out there? I don't know if you want to do that, but otherwise, I think this has been an excellent discussion.
Yeah, here's what I would say, and any time that you come up with a great innovation, or start to apply innovation, there is going to be frustration about the pace of uptake. But I think if you look at uptake over the last, what I would say is uptake over the last 5 years, you should be heartened that the direction of travel is one in favor of both market efficiency and regulatory respect. Mm-hmm. Said another way, if you eliminate the short-term bumps in the rearview mirror, we've come a long way.
Jay, this has been, like Santiago said, this has been an awesome conversation. I actually have one super quick question to ask you, which is, when you were in the chairman of the SEC position, there's all these crypto people who are always tweeting at now Gary Gensler when you're sitting in that position, are you seeing these tweets? Are you seeing anything that happens on crypto Twitter, or are you completely ignoring everything?
Look, you can't ignore everything, especially when people come up and say, "Hey, this one's really funny. Have you seen this?" I didn't know you looked like Homer Simpson. That kind of thing. But you accept that as part of one of these jobs. Look, the SEC, and I think you heard, I'm very empathetic to whatever Gary has to do, because 50 million American households are invested in the markets. It's your job to do the best you can for them, but you're not going to make everybody happy. That's just life, and you have to accept that. But doesn't mean you don't try.
True. I think that's all you can do. So, Jay, want to be respectful of your time. Thank you so much for coming on. This was a fantastic conversation. Really enjoyed it, and hope you did as well.
I did. Really great. Thank you. Thank you both.
Thank you, Jay. Thanks for coming on. Really, really great honor having you here.
Amazing. Thanks, Jay. Take care.
Okay. See ya.